Hi, good afternoon, everyone. This is Elki here with you guys today. Welcome to our third quarter 2025 market outlook. All right, today we are proud to with Berhad Research to share with you a little bit more about the markets. I know things has been exciting. Okay, with yesterday's special announcement from the PM, and today we have new even more informations and also upcoming plans review on the technology sector. Okay, I bet many of you right here would want to know what are the strategy available and what is the outlook for the economy for the third quarter upcoming these few months. Okay, so without further ado, we're gonna start our section today. Okay, first we will start with the our Berhad Research Executive Director Victor to share with you share with us about the economy outlook. Okay.
outlook. Okay.
Then following that,
Then following that,
we will follow with Kenneth,
follow
the
with
head of
Canon.
research, who will share with us about the stock updates. Also following by our analysts Chloe and Jesse to share their stocks coverage. And lastly, me myself will cover with some of the technical outlooks of the markets and also some of the picks that might suitable for trading. All right, okay. So let us start with Victor today on the economic outlook. Victor, the floor is yours.
All right. Good evening, everyone. I hope you can hear me. Yeah. Okay. Let me try to set up the mic a little bit. Okay. All right. So as I said, good evening, everyone. Welcome to our third quarter economic and market updates. As you can see from the title, we are actually in search of stability, which fortunately we are getting some at this point. But obviously, things are not so straightforward. So it may turn again in the second half of this year. But nevertheless, it will be certainly going to be fairly volatile looking ahead. But then, there are, of course, opportunities plenty, given that our valuations are fairly attractive at this point. But I will leave that to our new head of research, Kenneth, to provide you with the updates on the markets. I will be concentrating on the economic side of things. So, without ado, we will be starting. I should be starting with the economic conditions of like globally as well as in Malaysia uh, in the past quarter as well as looking ahead. So on our agenda today, I would start with the global and Malaysian economic review. I will also follow on with the economic outlook, whereas Kenneth will be presenting the equity market review as well as the outlook. Our colleagues Jesse and Chloe will present to you some of our stock picks for this upcoming quarter. Before Elke will present to you the technical indicators and the technical side of things. So uh, we'll start first with the um, if I can get this slide to move. All right, here we go. All right, so looking at the global economic review, so essentially, even with President Trump's tariffs threats in the first quarter of this year, it didn't really matter so much as, for the most part, global economic conditions held firm, and it's only, in fact, for much of the second quarter as well, which is ongoing, the economic conditions have been holding firm, mainly on the back of um, the front-loading activities. But nevertheless, on the first quarter reported numbers, um, global economic conditions were actually fairly firm, basically with the help of the combination of easing inflationary risk as well as the prospects of further reduction in interest rates in 2025. At the same time, also, there were optimism of sustained economic growth for the year, even though there were signs of some easing in the economic conditions, particularly in the US at the start of the year. But nevertheless, Asian and European economies were actually quite positive, sustaining their strong performances from the end of last year, the fourth quarter last year, into the first quarter of sustained economic growth, as well as the potentially easing uh, monetary and fiscal conditions. So, if you look at the manufacturing side, I think that's a very clear signal of where the economies are headed. You can see from the chart that both the manufacturing and services PMIs are well above the 50 level, even though there was like some slight softening in some of the matrices earlier on. But nevertheless, you can see that they are all above 50, and that is actually encouraging, as it signals the continuing strength in demand for both products and services. So all this actually was before the U.S. president on the 2nd of April announced the Liberation Day tariff announcements. But nevertheless, if we look at individual economies, as I said earlier, the US economy was actually slower um, on the back of higher imports, and of course, they have decreased government spending. Even though that domestic strength, domestic demand, and domestic consumption strength was firmer. Over in Europe, growth was actually anchored by firmer domestic demand, coupled with stronger exports as well as capex spending. Over in Asia, the economic conditions were actually quite mixed, mainly because in parts of Asia, there was still a proliferation of AI and tech related uh, growth. Here we're talking about countries like South Korea. They were seeing a lot of strength and in the tech AI related exports. But China, of course, were facing headwinds domestically because of the slower exports, partly due to already the trade impact was affecting its external environment, as well as the same time, its domestic economy was not doing too good, mainly on the back of the sustained weakness in its property sector and, of course, slowing consumer spending. But in other parts of Asia, where especially in India and Southeast Asian nations, performances will economic performances were actually quite firm, mainly supported by the the domestic activities. So that's a quick update on the global economy. Looking on to the Malaysian side, uh, as you can see from the table, uh, GDP continues to slow, although it's still at the growth level. In the first quarter of this year, growth was about 4.4%, still lower than what was reported in the last quarter of last year at 4.9% now. Uh, Much of it, of course, is actually due to the resilience of the domestic spending. That actually helped to cushion against the slower external environment. Here we're talking about exports. And on domestic side, basically there were a lot of improved tourism activities, and of course near-term trade recovery. If you recall, first quarter this year, we had the two major festivities, which is the Chinese New Year and Hari Raya. So all this actually helped to bolster domestic activities, especially the wholesale and retail spending. Um, Also, there was some recovery in exports. These are actually mainly for the E&E products, mainly on the back of higher demand from the artificial intelligence subsector as well as big tech. At the same time, also the job market was actually quite robust. If you're looking at it, the the country's unemployment rate has fallen to about 3.1 to 3%, and that is about the lowest it has been for quite a while. So that actually also of course helped to sustain the household spending pattern. As I said earlier, external trade. If you look at the exports of goods and services in the first quarter, it continues to slow, and this is quite a substantial slowdown in terms of growth. In the fourth quarter of last year, the growth was about nearly 9%. But this in the first quarter of this year, it's half essentially, which is about 4%. Basically, much of the lower exports were due to lower exports of mining products, but E&E exports actually recovered and recovered stronger than what it was in the previous quarter. Right. So, in terms of domestic condition, domestic demand uh, moderated slightly, mainly on the back of slower growth in private consumption. But actually, there was still a lot of activities in the tourism, transport, and F&B activities that actually helped to shore up domestic demand. In terms of sector, the services sector posted another growth quarter, 4%, still slower than what was recorded in the previous quarter of a 5.5%. A lot of this, as I was saying earlier, is supported by the wholesale and retail subsector due to the prevailing festive seasons. Yes, the mining sector contracted again due to lower crude oil and natural gas output. If you look at the agricultural sector, it actually returned to a growth, very small growth of just about 0.6% year on year. Um, Much of it is actually helped by the expansion of the marine sector that grew about 10.3% in the first quarter of this year. The palm oil sector actually still recorded a contraction, but a lower contraction of 3.1% in terms of output compared to the contraction of 5.3% in the fourth quarter of last year. In percentage wise, the construction sector again expanded very strongly, this time at 14.2%, mainly on the back of a lot of construction in in fact, a lot of on all subsectors, particularly um, the ongoing specialized construction for data centers and all of that, as well as. But having said that, there was some moderation in the momentum, basically on the non-residential sector, which only grew by about 21.4% year on year. So if you look at the manufacturing side, um, it growth actually moderated slightly to 4.1% compared to 4.2% in the fourth quarter of last year. A lot of it is actually sustained by the performances in the electrical and electronic and optical products. So it actually grew stronger compared to the fourth quarter of last year. Whereas other manufacturing sector components like motor vehicle and transport equipment subsector actually posted a contraction of about 10.3% in the first quarter of this year. So looking at the overall capex spending, it is actually slower, just below 10%, but it is compared to the fourth quarter of last year, which actually was 12% growth, was of course is lower, mainly on the milder growth in property type of assets. But that um, helped to offset growth improvements, or offset, sorry, by the growth improvements in the machinery and equipment assets as well as other assets. So you can see that on the corresponding manufacturing statistic up to March 2025, you can see that the trend is still very positive, remaining well above the 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 zero growth level, and is now hovering, say, around about 3 to 5% growth, which is very encouraging as it continues to show that the manufacturing sector is still seeing a lot of demand, whether it's local or from the external side. Okay, so that's a very quick review of the Malaysian and global economic uh, conditions. Looking ahead, you can look at the table right now. Um, Economic conditions are likely to moderate in 2025. So essentially, this has been said already in the first quarter, in the second quarter, our second quarter quarterly outlook. So there's actually little change going into the second half of this year. So what are the main issues? Basically, the lingering trade and and geopolitical headwinds to continue affecting growth prospects. What is the biggest concern is certainly the U.S. import tariffs, and this is likely to affect global supply chain countries, and this is going to see trades likely to slow ahead, particularly towards the, the 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 final part of the year. Already there are some impact of the tariffs, and they're likely to filter in more to the global economy in the upcoming months. And with higher prices, obviously this is going to temper uh, consumer spending growth. So if you look at the trade itself, the World Bank has actually cut the forecast for global trade to growth actually to just 1.8% in 2025. And this compares to it basically is half the growth rate that was recorded in 2024. Now, even if uh, there are some trade agreements, the latest being Japan agreeing to the U.S. On a trade agreement, uh, whichever way you look at it, the tariffs are certainly going to make goods pricier, and certainly from the third quarter onwards. And this is likely going to affect demand in the U.S. And what happens is there will also be a cascading effect flowing into the supply side. These are mainly export dominant countries. So at the same time also, if you look at it, global demand actually is actually quite tepid as we speak, mainly due to the already tight supply and higher prices, as well as slower recovery in many parts of the the world. So affecting consumer and business spending uh, over the past couple of months. So what has happened also is that structural and geopolitical risks are also stifling demand, and inflation pressures are still lingering. With that actually could see central banks reversing its dovish inclinations to a more hawkish environment if the inflation rate continues to tip up higher lah. So with all of this, particularly in the US, obviously the economic prospects are likely to remain quite slow into the second half of this year. This has already seen global GDP estimates for the year cut to anywhere from 2.3 to 2.6% year on year. This compares to the earlier estimate of 2.6 to 2.9%. Even with this new estimates, we think that the estimates are still very fluid, and of course will be subject to the changing, the flip flop, or even the changing conditions, uh, economic conditions ahead, especially when new tariff events unfold. But if you look at it overall, the tariff impact has actually been relatively minor, and many economic indicators from many countries are also displaying firmness for the time being. Much of this, of course, is due to the reversal of President Trump's tariffs. And then obviously it's a negotiating tactic. So it will continue to actually affect the outcome of the global economic conditions for the rest of the year. So if you look at it, even though the global GDP is likely to slow quite substantially in the second half of this year, a recession is unlikely to occur in 2025, mainly because a lot of it is cushioned by the firm market conditions in the first half of this year, and obviously the possibility of a slowdown in the second half of the year has become more pronounced with the tariffs. Um, on the other hand, also, if you look at it, employment prospects are actually slowing, and this could be further affected by the tariffs when it does pick up. So there could be further increases in the global unemployment rate, and this could actually, with the unemployment rate tipping lower, consumer spending growth will also be affected. By far, the biggest concern would certainly be inflation, and of course, with higher inflation, the risk of uh, of um a steeper interest rate cut is unlikely to materialize so soon. But if it does, it actually helps, and it will be used to contain prices. So with rates to stay higher, it could actually exacerbate the slowdown in the interim. So individually, if you just look at the US, its outlook actually remains quite vulnerable due to the unpredictable tariff policies. Of course, there's employment, immigration, and inflation data that will have a bearing on supply and demand dynamics. So what that means is its year to date resilience will be severely tested in the second half this year when the effects of the tariff are cascaded into the broader economy. So that will bring about higher prices and trim demand for goods. In Europe, uh, the low to moderate growth rate is actually expected to continue, mainly due to subdued demand from the prevailing economic and geopolitical headwinds. Asian economies, meanwhile, should also see increased challenges to its growth performances, and partly because of tariff, and of course the lower demand, and this is going to lead to slower GDP growth for the rest of the year. So on the Malaysian side, if you look at it, obviously the outlook right now for the second half of the year is actually still clouded by the hefty tariffs on Malaysian goods, which is right now set at 25% exported into the US. So it is quite obvious that the earlier projection, GDP projection of 4.5 to 5%, is definitely at risk of not achieving. So already there has been a cut in the latest GDP estimates, ranging from anywhere from 3.9 to 4.2%, mainly due to the tariffs that is going to cause a cascading effect onto the country's exports and other export supporting industries. So looking at the table, the forecast right now uh, from the Bloomberg consensus estimate is placing the 2025 estimate at 4.2% and barely growing in 2026. So looking at other matrices, you can see that with the latest interest rate cut, the OPR is likely to come off further heading into 2026 as conditions deteriorate. So even with the recent round of electricity increases, as well as the introduction of the SSD, CPI rate is expected to remain quite low, hovering around the 2 to 2.2% level. So that's so much on the consensus estimate. But back to the external side, if we look at it, Malaysia's direct export is only about 10 to 13% to the US. But what is more worrisome is the exports of intermediate goods to other Asian countries, uh, in particular China. So that will be affected by the tariffs that are placed on this supply chain countries, and that would of course reduce the demand for upstream products. So that's where Malaysia is at. So all, all in all, there is still quite a bit of uncertainties on the tariff impact on the Malaysian economy. As I said, also it's also partly due to the evolving nature of the tariffs. So much of the prospects for this country is also tied to the ongoing negotiation to reduce the 25% tariff that has been imposed on Malaysian that will be on Malaysian exports if we are not able to come up with an agreement starting 1st of August. So right now, if you look at the recent agreements that were reached by our neighbors with the US, of course, 19% is from Indonesia, and 19% is certainly a quite high number. So we may be subjected to that as well. So again, as the negotiations are still ongoing, the outcome is certainly uncertain at this point now. But what is fairly certain is that there will be an effect on the country's GDP for the year. So we are looking at anywhere from 0.2 to 0.5% cut to the GDP estimates for the year. And this is already at the baseline level of a 10% tariff. And of course, all this is actually due to the slower external environment. So what we need to do is to continue what do you call that? Looking for mitigating measures, and of course, for one thing that is helping is our country's diverse export base, and of course the products that we have and that would actually help to mitigate some of the risk. At the same time, also, we may be able to benefit from the trade diversion from China, and then at the same time, also, product substitution may not be possible in some cases. So thereby, we do have a advantage there, and there will be captive markets for some of these products, despite the tariffs and higher prices. While that helps to mitigate some of the risk, domestic activities will certainly have to step up and to cushion the country from the vagaries of the external sector lah. So right now, obviously, domestic activities will be seen as the catalyst. Uh, Even though that the estimates could be slower, mainly due to the introduction of the SST and the reduced subsidies ahead. But nevertheless, if you look at it, the availability of domestic activities, here we're talking about infrastructure, construction, increased inbound tourism will certainly be welcome for the rest of the year. At the same time, also we can see that consumer spending should be very much preserved by the combination of strong employment position uh, in this country, the continuing wage growth, as well as increased capital and investment outflows. So all in all, the private spending growth will stay firm in the second half of this year. So the forecast for private sector spending growth is still expected to be anywhere from 5 to 6% for the full year. So government's fiscal support, so for that, and monetary support, including the lowered interest rates and reduce RON 95 prices, will certainly help to bolster the domestic economic activities. If you look at the table on the right, you can see that these are still the official uh, numbers presented by Bank Negara or the government. But again, all this will be changed. In fact, it's quite soon, where as soon as next month, when the country's second quarter GDP numbers are announced. So with that, I would conclude uh, my presentation. I'll now hand you over to Kenneth to give you an update on the equity markets uh, ahead. Thank you.
Good evening, everyone. We will review and outlook. In second quarter 2025, global equity markets started off on a volatile manner following the surprise US tariff announcement, but most of the markets were quick to rebound after the implementation was deferred to 9th July and subsequently to 1st of August. Markets were also shaken by the escalating geopolitical tension in the Middle East between Israel and Iran, which resulted in a brief spike in oil prices. Meanwhile, uncertainty over US economic policy, including proposed tariff and timing of interest rate cut, pressured the dollar and boosted gold prices to 3,300 per ounce. Despite the headwinds, opportunistic buying after April's dip drove the strong rebound, with the exception of France's CAC 40, with several markets hitting all-time highs. Onto Wall Street, US equities markets staged a brief pullback on tariff concerns before forming a V-shaped recovery following the 90-day delay in its implementation, with major indices hitting new highs, led by gains in technology giants, with the Magnificent Seven delivered an average gain of 27% during the quarter. This is against the S&P 500 of about 11%. Elsewhere, European equities posted broad gains in second quarter 2025, supported by a cumulative 50 basis points of rate cuts by the ECB, which has now recorded its sixth cut and easing trade tension. The ECB may also deliver its seventh consecutive trading cut later tonight. Coming closer, Asian equities broadly advanced and ended second quarter 2025 on a positive note, also supported by easing trade concerns and improving investor sentiment, particularly on the technology and artificial intelligence sectors, with AI or technology players in Hong Kong and China playing catch up to strong gains that was delivered in the US markets. Back home, the FMKSI recorded a 1.3% Q-on-Q gain, rebounding above the 1500 level on a relief from the Liberation Day tariff pause and a temporary US-China tariff reduction agreement. Despite this recovery, overall sentiment remained cautious due to weak corporate earnings, placing the index in the mid-range performance among regional peers. Sector performance was mixed with the construction sector, which recorded 12.6% Q-on-Q gains, took the front seat amid renewed interest in data center infrastructure thematic space, as well as the strong earnings delivered in the first quarter of calendar year 2025. On the other hand, the healthcare sector, which recorded 7.2% Q-on-Q decline, was the worst performer as gloves players continue to grapple with prolonged headwinds such as unabated oversupply conditions, stiff pricing competition, and stronger ringgit. While the key index held onto its ground, the broader market remains challenging as the selling pressure from first quarter 2025 extended into second quarter 2025 amid uncertainties over the tariff. This resulted in the FM small cap and FBM ACE indices shedding 13.3% Q-on-Q and 10.6% Q-on-Q respectively. We gather that foreign funds remain in a net selling position, though it has eased to 2.16 billion worth of Malaysian equities in the second quarter of this year, against the 9.96 billion worth of value of shares in the first quarter of this year, in tandem with the exodus of foreign funds across emerging markets. Domestic institutions continue to be the main support with net buying of 2.47 billion worth of shares, while retail investors recorded net outflow of close to about 600 million. Despite the strong recovery in the later part of second quarter 2025 and key global equity indices chalking up new highs, market conditions could become choppier in the second half of this year, overshadowed by continuing tariff issues, slowing economic outlook, and overstretched valuations. Trade policies uncertainties presents the highest risk to equities market, which is likely to remain fluid for now. Still, market players have largely cast aside the lingering concerns, with thematic plays continuing to support the equity markets. In particular, the AI plays and big tech will continue to bolster investor sentiment and provide support to equity markets. Recent trade deals such as with the likes of Vietnam, Philippines, and Japan are also helping to shore up market confidence. The market is also holding out for further interest rate cuts on the weaker economic prognosis in the second half of this year. That will augur well for corporate earnings and equities, with an outright recession also appears slim at this juncture, given that economic projections are still pointing to growth, albeit at a slower pace. With economies largely holding up despite the tariff, equities market conditions should also remain firm for now, but remains vulnerable to adverse economic and trade developments. In the event upcoming economic data deteriorates and more than expected, there is a risk towards a steep market pullback, particularly if inflation becomes hotter than expected. That could lead to an erosion in spending and income. US equities remain the most overpriced and is at the most at risk of a severe pullback. Tariff-induced headwinds could continue to cloud its outlook even as earnings are seen holding up and recession appears unlikely. Market players will monitor inflation and tariff developments, as well as signs of economic cooling, with possible rotation into cheaper equities, as many bellwethers are trading at expensive levels. European stock markets should also hold up onto optimism over potential trade deals, bolstering its economic recovery prospects. Inflation is tamer, and the reduced interest rate will also instill confidence to their broader economy, albeit trade overhang and geopolitical risk remains. Asian equities had been on the purple patch on a pivot from the other equity markets. This trend is likely to sustain the diversion from US dollar asset, coupled with firm earnings projection despite the tariffs. The continuing tech and AI plays will also shore up interest in Asian equities, albeit trade concerns and slowing demand could still affect sentiments. Despite the trade disruptions, global equity earnings were not severely impacted, and the prognosis for earnings to grow 8.1% year-on-year in 2025, just moderating slightly from earlier forecasts of 8.7% year-on-year. US and Asian corporate earnings could still rise by about 12% year-on-year in 2025 to cushion the flat European earnings. Valuation-wise, US equities remain at elevated levels, well above its forward average PER norms of 15 to 17 times, leaving it vulnerable to a pullback if economic outlook deteriorates. ASEAN and European indices, meanwhile, are largely fair given the still challenging economic and business outlook. Based on our present valuations, there appears to be little upside potential left. Looking at this chart, both the MSCI All World Index and S&P 500 are trading above the historical 5-year average, implying valuations are lofty and overstretched. Now moving on to the Malaysia equity market outlook. While the FMKLCI showed a noticeable rebound after the sell-down in early April 2025, progress has since stalled, resulting in a directionless movement with the recent months as the key index wobbled between the 1500 and 1550 level lately. Going forward, we believe market movements will be dictated by the US and Malaysia trade negotiations, with potential tariff-related uncertainties affecting sentiment. With the deadline for tariff negotiations have pushed back to 1st of August 2025, uncertainties will prevail and any pullbacks may create investment opportunity, particularly within the strong dividend-paying stocks. In response to growing concerns over economic headwinds and to support domestic demand, Bank Negara Malaysia has taken a preemptive measure by reducing the overnight policy rate by 25 basis points during the latest monetary policy committee meeting. The move may likely to sustain domestic consumption, which has been the main anchor to Malaysia GDP growth in recent quarters. Investors will be keeping an eye to the upcoming tabling of the 13 Malaysia Plan in Parliament next week. We expect the key blueprint to focus on two key structural reformations, aiming for the nation to achieve the high income status by 2028. Under the prevailing uncertainties surrounding trade policies, we continue to favor domestic-oriented sectors that are less vulnerable to external shocks, such as construction, consumer, utilities, and renewable energy. Since the start of the year, local investors have been supporting Malaysia equities worth 10.2 billion in net buying, but further recovery will depend on foreign funds inflow. With potential US interest rate cuts are on the cards, the narrowing yield differential between two countries may entice foreign investors back into our shores. Also, with the implementation of tariff delay, this suggests full impact may only be felt in the final quarter of this year, keeping corporate earnings growth prospects uncertain. Broader market may face extended consolidation due to the lack of fresh domestic catalysts, with external developments playing a key role in shaping markets sentiment. We expect the FMKLCI to consolidate between the 1500 towards the 1550 levels over the near term. A favorable outcome from US trade negotiations could lead to a positive earnings revision and stronger economic outlook, potentially lifting the index towards the immediate resistance at 1580, followed by the 1600 level. Downside-wise, should the 1500 level fails to hold, key support is pegged at the 1472 level. We gather that earnings growth for FMKLCI and FM AMAS is projected to remain subdued, only at a low single digit of 1.6% and 3.7% year-on-year for 2025, owing to the impact of tariff uncertainties before marching on at a stronger pace of 6.6% year-on-year and 8.7% year-on-year in 2026 respectively. Valuation-wise, both the FMKLCI and FM AMAS indices are attractive priced as they are below the historical forward average PER average of 14.6 times, 14 to 16 times, which provides bargain hunting opportunity, but any potential upside hinges towards the outcome of the tariff developments. Looking at these charts, the FMKLCI is trading below its historical 5-year average, suggesting valuations are attractive at this point of time. However, we do caution that the discount has been prevalent since mid-2021, suggesting upsides could also be capped. So that is all from my end, and we shall move on to the stock picks for this quarter.
Good evening, everyone. I'm Chloe. Today, I will be presenting analyse Berhad and sharing some updates about the company. First of all, analyse is a leading integrated player in agricultural and industrial chemicals in Southeast Asia. The group operates across 5 main business segments, but the core revenue and profit drivers are the industrial and agricultural chemical segment. The industrial chemical segment involves the manufacturing of ethanol and phosphoric acid, as well as the distribution of a wide range of industrial chemical products. Notably, Income is one of only 2 major ethanol producers in Malaysia. Meanwhile, the agricultural chemical segment focuses on the manufacturing, formulation, and sale of agrochemical products. The group holds a unique position as the sole large-scale producer of herbicide active ingredients in Southeast Asia. These active ingredients, or in short AI, are the core chemical compounds in herbicides that kill or inhibit growth of unwanted plants. As shown in the pie chart for FY25, the industrial chemical segment contributed approximately 62% of the group's total revenue, while the agricultural chemical segment accounted for 29%. Despite its smaller share of revenue, the agricultural chemical segment offers higher profit margins, making it a key driver of overall profitability. On the financial side, Ancom just released its full year FY25 results last week. After delivering 4 consecutive years of record earnings, FY25 saw a slight moderation in performance. This was largely due to a weaker contribution from the industrial chemical segment amid subdued global commodity prices, while the agricultural chemical segment was also impacted by elevated freight costs, particularly during the first half of FY25. Despite that, Income long-term outlook remains promising. The group is poised for a stronger performance in FY26, with the agricultural chemical segment expected to remain the core earnings driver. This will be supported by several key catalysts, including stronger sales of existing higher margin AI products, as well as the commercialization of a new AI product named AIT. Production has commenced in April for AIT, and we expect to see a full year contribution in FY26. Additionally, the planned expansion of MSMA into Brazil's soybean market presents a significant growth opportunity for the group. While regulatory approval for MSMA label registration in Brazil has been slightly delayed to end 2025, we believe that successful entry into this large market could boost earnings moving forward, given that Brazil's soybean hectareage is nearly 5 times larger than sugarcane. With that, we project FY26 revenue to grow to about 2.2 billion ringgit, with PATAMI estimated at around 101 million. With the outlook in place, let's now look at the key investment merits that support our buy recommendation. Firstly, the rising global population and increasing food demand continue to fuel the need for enhanced agricultural productivity. This in turn supports consistent demand for agricultural chemicals, which are essential in improving crop yields and efficiency. In addition, the ban on the widely used herbicide paraquat in countries such as Malaysia, Thailand, and Brazil presents a major opportunity. The group is poised to penetrate this paraquat replacement market through 2 of its formulations, where both are identified as close substitutes. On the product development front, Ancom currently has a portfolio of 6 AIs and is planning to roll out 2 more in the near term. The first AI, known as AIT, began production in April and is expected to start contributing to the group's earnings in FY26, while another AI is targeted for trial production by year-end with projected earnings contribution from FY27 onward. Moreover, escalating geopolitical tensions are also prompting global farmers to seek alternatives outside China to diversify supply chains, and Ancom stands out as the only large-scale herbicide AI producer in Southeast Asia, positioning it as a beneficiary of the China Plus One strategy. The group also intends to broaden its market presence for its AI products by pursuing label registrations for crops with larger hectareages, such as the soybean market in Brazil and the palm oil industry in Indonesia. The Brazilian soybean market is approximately 5 times larger than the sugarcane market, while the Indonesia palm oil industry also surpasses the Malaysian market in scale. And lastly, I understand that many of us may be concerned about the potential impact of the recently announced US tariffs on Income-Knowledge. Fortunately, the management has reassured that the group's exposure to these tariffs is minimal. Exports to the US, which mainly comprise timber preservatives and MSMA, only account for 10 to 11% of the total agricultural chemicals revenue. And more importantly, both products are exempt from the new tariffs, with timber preservatives classified under the pharmaceutical category. Therefore, earnings shouldn't be affected in any meaningful way. In view of the group's firm growth prospects, we reiterate our buy recommendation on Income-Knowledge with a target price of RM1.20 by ascribing a target PER of 13 times to its FY26 EPS of 9.2 cents. And based on today's closing price of 92.5 cents, there is a potential upside of about 29.7%. Thank you, and I will pass it over to Jessie to continue.
Good evening, everyone. So I will be talking two stock picks that's under my coverage. So for AWC Berhad, this company is a one-stop solution provider of premier engineering services and asset management solutions. So AWC is principally engaged in the business of providing building maintenance, critical asset refurbishment, automated waste collection, high-quality plumbing, real engineering, and also the management. So the group generates its revenue through 4 divisions, which are Facilities Division, Environment Division, Engineering Division, and Real Division. So AWC maintains the facilities, security, and cleaning services to the federal government, commercial, healthcare, and university under Facilities Division. And this division makes up half of its total revenue contribution. For Environment Division, AWC involves in designing, supplying, installation, testing, and commissioning of the automated pneumatic waste collection system under the Stream Group. So AWC will also carry out operation and maintenance services of this system to its clients, such as property developers, airports, food catering centers, hospital, and many more. AWC provides a series of plumbing services under Engineering Division, including designing and building of cold and hot water plumbing system, rainwater harvesting, distributing the components of aircon system for buildings, and providing building management services. So under Real Division, AWC will supply track materials, rolling stocks, provide maintenance services of railway tracks, track and depot equipment, as well as supply and commission of track tools, equipment, and machineries. So some updates for the Facilities Division. AWC has secured the contract from the federal government client since 10 years ago. So based on the chart on your left-hand side, the Facility Division record an average of profit before tax margin around 14% during the initial 3 years of the commission period. So with this contract is set to expire by end of December this year, we believe there's a potential for a step up in contract value should AWC successfully secure the renewals. So historically, margin have been stronger in the early stage of such contracts, and we anticipated a similar trend if renewals are awarded. And for Environment Division, AWC's Stream Group is responsible for managing wet waste, accelerating the overall garbage collection process, and providing system maintenance. While we expect AWC may take a longer time to secure projects in the Saudi Arabia region, given that the Line Smart City project is still in the early stage of groundwork complete earlier this year, we still remain optimistic on the long-term potential. Although near-term momentum in Saudi Arabia might be subdued, but we expect the margin under environment division to sustain about 25% as we see continued growth opportunities from rising adoption of the stream system by property developers in Malaysia, particularly in the Penang and Johor side, as well as a steady contribution from the Singapore's housing project. So we recommend a buy call for AWC with a target price of RM1.38 based on our sum of the parts valuation, supported by a strong order book, being a proxy to the booming environment industry, which spurred by the job flows from domestic and overseas projects, a proactive exploration of global business opportunity, and the company business which promoting ESG practices. And next, I'll be talking about Infomina. So Infomina is an IT solution provider that focuses on building, managing, and supporting technology infrastructure for large enterprise, both public and private. And Infomina generates its revenue through two segments, which is turnkey and renewal segment. Turnkey segment is mainly involved business of designing and implementation of technology application and infrastructure solution, while renewal segment is providing ongoing technology infrastructure operation, maintenance, and support service. So the group just released their results yesterday. Their revenue decreased by 8.7% year over year to 53.4 million in fourth quarter FY25, primarily due to about 61% drop in the contribution from the turnkey segment, which has seen higher deliveries in the previous corresponding period. The renewal segment remained on a growth trajectory, with revenue rising about 17% year over year to 45.8 million from 39 million in fourth quarter FY24. But the group booked about 10 million provision for doubtful debts related to outstanding receivables from one of the Philippine customer, which weighed on the operating expenses and result in a net loss of 3 million during fourth quarter FY25. But excluding this one-off provision for doubtful debts, FY25 full year core earnings meet our expectation, which accounting for about 103% of our full year forecast. So Infomina's order book currently stands at 289 million and 839 million worth of tender book as of end of May 2025. Looking forward, we expect 300 million order book replenishment in its financial year 2026, supported by the contract renewals and potentially capacity upgrades from its key existing clients in Thailand and Philippines, actively onboarding about 46 Japanese clients within FY 2026. Along with a stable revenue and margin contribution from the renewal segment, we are also anticipating 19% of core earnings growth in FY 2026. For now, we believe the provision for doubtful debts has been priced in, as reflected in the share price decline between April and May this year. So for now, we reiterate our buy call on Infomina with a target price of RM1.42, implying an upside potential of about 48% based on today's closing price, which is currently trading between the -1 and -2 standard deviation range. Yeah, that's all from me. I will pass the floor back to Elkie.
All right. Thank you very much, Jesse. Okay, thank you very much, Jesse. Okay, so we will continue with the technical analysis part. All right. Okay. Yep. So for my part, I will cover on some of the technical outlook for some indexes and also some commodities. Meanwhile, I will be sharing some of the picks that I personally think it's looks favorable and also positive at this moment. Okay, but like I said, all this it should be taken as for education purposes only. All right. Okay. Yep. So first I start with some updates. Okay, on the previous sharing on the second quarter 2025 market outlook. Okay, so in our last sections, we have shared four counters. Okay, which is Westport, Hatalega, 99 Speed Mart, and also Emirates. Okay, yep. So among four of them, apparently, Westport is the one that's outperformed. Okay, among all, whereby Westport has benefited from the port tariff hikes. Okay, and went as high at 36.8% from the day where we were sharing on the counter. Okay, so out of the four, Westport and 99 Speed Mart has reached the TP. Okay, as for Hartalega, it hit the stop loss. Okay, Winner and REITs has been steady and also distributed dividends here. So if we look into the chart of Westport, okay, we can see the green bar right over here is where we are seeing the announcements of the port tariff hikes. Okay, where the share price actually taken off and then continue to move higher. So for Westport at this moment, we are seeing the price is steady above 5 ringgits and it's holding well along with the 20 days moving average, whereby the upside it could be still there, whereby there are speculations and also rumors saying that they might able to include into the FBM KLCI index the top 30 by end of this year. Okay, so if that comes through, then we might continue to see Westport continue to trade higher. As for Hartalega, okay, as what we are seeing, Hartalega has been trading lower. We were calling Hartalega on the MACD bullish divergence, okay, that happening whereby MACD has been trading higher while the selling has slowed down. Okay, unfortunately, the selling continue and the bullish divergence it prolonged. Okay, yeah. So at this moment, we are still seeing that there is a potential reversal and rebound, bargain hunting in these stocks. Okay, but we need it will be good to wait for a confirmation, a bullish confirmation rebound before we go in to call for the buy. Okay, the rebound. Yeah. As for 99 Speed Marts, okay, we can see 99 Speed Marts has been rebounding, okay, forming the double rejection from near the 2 ringgit levels and has been trading higher since then. Okay, with yesterday, our PM Prime Minister special announcement and also the incentive. Okay, it actually the biggest winner will be the consumer companies, okay, consumer counters, where 90 Speedmart actually had quite a rally yesterday. Okay, so from here we can see that there's still some upside for 99 Speedmart, whereby we can continue to hold on to it if you're still holding 99 Speedmart. Last but not least, Emirates is holding well and trades above where we were looking at it in the month of April. Okay. Yep. So wrap it up. If we look into the first half of 2025, we can see that most of the sectors they are not performing. Okay, for the first half, except for REITs. Okay. Yeah. So out of all, we can see that healthcare as the top losers among all the industry. Okay, and followed by technology for the first half of this year. So if we look into the overview of the markets, where is the market is going? First, if we look into the US side for the S&P 500, I'm totally agree with what Kenneth was sharing, saying that the view of the S&P 500 could be overstretched. Whereby, if we look into from the technical side of view, we are seeing that despite the S&P 500 has been making record high and has been trading higher along in an upward channel. Okay, but we are seeing the buying momentum actually has slowed down with the bearish MACD divergence with a lower high forming. Okay. Similarly, on Nasdaq, we are seeing similar patterns whereby the buying sentiment could be slowing down. Okay. But remember what we were seeing on the Harta Lega, the divergence it could prolong and continue to go on and on until we see, saw a strong signal whereby we need to see a strong selling, a massive selling, and then followed by a continuous breaking lower. Okay. Yeah. So as of right now, if we are yet to see any strong selling bearish candle, um, the index can continue to hug along with this 20 days moving average and continue to trade higher. Okay, even the momentum has been slowing down. Just that if you are trading on US stocks or the US indexes, all this, you might really want to be careful and also monitor it closely and look for any sign of heavy selling to exit your position. As for our local benchmark index FBM KLCN, okay, we can see that despite the strong gain and uptrends in the US indexes, we are seeing our local benchmark index is trading more towards on a sideways. Okay, so as of right here, we are seeing that the FBM KLCI is below the 200 moving average, and also we are seeing the 20 days moving average is pretty much flat at this moment. So on the technical outlook wise, we are likely to see 1500 to be the immediate support, and it will be a significant one. Okay, but the upside will be also capped somewhere around 1550 to 1580 levels. Okay, until we're able to see the breakout from either sides. Otherwise, our benchmark index, it might continue to trade sideways without any strong directions. As for small cap, okay, although we are seeing it's going on sideways as similar to our benchmark index, but there is a little bit more recovery is to be seen on the IPM small cap, whereby we are seeing the small cap index has been holding well above the 20 days moving average. So in this view, in the view of this, we are seeing that there could be a potential short-term upside to retest this high for our FPM small cap in near future. Okay, but if we're looking in a longer term horizon, it might continue to trade in a sideways range with 14,800 as immediate support, and also somewhere around 16,400 as the resistance for our FBM small cap. All right. Okay. As for our USD MIR, ringgit has been strengthening since early April. Okay, and has been holding well. Okay, yeah. So this the impact of this strengthening in the ringgit might be shown and also seen in the coming QR in August by some of the companies. So later I will be sharing one of the company that could be benefited from this strengthening ringgit. As for our as on the commodity side, FCPO, okay, crude palm oil, we are seeing crude palm oil has been selling lower after marking the high of 14 at somewhere around 4700s in early of the year, and has been trending lower until mark a low in May at somewhere around 3800 levels. Okay, the rebounds in the CPO, the crude palm oil price is more towards lifted by the higher price in its competitive vegetable oils like soy oil, given that there is a change on the biodiesel mandates, okay, rather than the increasing demand. Okay, so as of right now, with this rebound from soy oil starting in mid of June until right now, given that we are seeing a potential peak in production in somewhere around September, okay, we might see limited upside for crude palm oil at this moment. Okay, yeah, and if we look into technical part, it is also approaching the resistance block somewhere around 14,400 to 4600 levels, with this this block right over here to be the immediate resistance block for FCPO. Okay, so pump FCPO could having a very limited upside as of now. Okay, and it might trade back somewhere around near to 4,000 to 4,000 and 4,100 levels. As for COMEX Go, okay, COMEX Go is trading on sideways, with also a higher low, but it's very well capped below $3,500. Okay, yeah, I believe the gold price is many see the gold, although we are seeing a lot of headwinds and also uncertainties still going on with the global markets. Okay, the interest for the gold as the as safe haven, it could be not as strong as what we are seeing during early of the year. Okay, whereby the rally actually started from 600 to 2600 all the way to 3500. Okay, whereby for those who want to buy into gold as safe haven, as safe havens to hedge against the uncertainties, they have done so during early this year. Hence, we are seeing the stagnant and also the sideways since April, since late April. Okay. However, if we are seeing any major changes and also the heightens of the uncertainties, then we might see the breakout of 3,500 levels, and from there we might see some trading interest into the jewelry and also gold related counters as well. Okay. Yep. Last but not least, we will be on the crude oil, the WTI crude oil. So this is the US West Texas WTI oil, the US oil price chart. Okay, we can see that in June we have a very volatile movement on the WTI oil on the Israel-Iran war, geopolitical pressure. Okay, and as of right now, as the oil price has dipped below the 66 dollars levels. Okay, the upside is the downside is we could see more downside for WTI oil, and it might continue to develop into a stronger downtrend towards 58 to 60 levels. Okay, until we able to see the oil price to steady trading above $70. Otherwise, we should continue to hold a more technically bearish view on crude oil price. All right. Okay. So the last but not least will be the trading ideas. Okay, some of the trading ideas for this quarter is I'm gonna start with seasonality. So I have compiled some of the seasonality performance for the industry for July and September for based on the past 20 to 24 years average. Okay, so we can see in the month of July until September, we are seeing July to be a more favorable month. Usually we could see more positive performance in July, but it's starting to go into mix in September or in August, or even turning worse in September. So as we are approaching the end of July, okay, it's good to consider to take some profits and also to free up some cash in order to able to get in when there are some bargain hunting opportunities arising in the month of August or September. However, if we compare in all the industry, we can see that in the third quarter of the year, energy and utilities could be the one that performing the best among all. Although we can see even for energy and utilities in the month of September, historically, seasonally, they could be going. They most of the time they are in red as well. Okay. As for some of the sectors and also catalysts that I'm looking at, it will be focused on some of the catalysts like mega infrastructure and also DC projects that has been announcing and ongoing. Okay, and besides that, this has been ongoing and come in line with what Kenneth was suggesting on the domestic sector part, which is construction property building materials as well. Okay. Other than that, personally, I also will be looking into some catalysts. Like recently, we have been seeing that for the first 5 months of this year, we are seeing a 20% increase of international tourist arrival, where that could help our tourism sectors, consumer products as well. All right. Other than that, we should see some of the sectors continue to be benefited from the national and energy transition roadmap. Okay. And last but not least, will be on the some companies could be benefited from a stronger ringgit, whereby that's some trading opportunities could arise from there, especially when we are seeing QR coming out in the next month in August. Okay, so the very first counters that I'm looking at, it will be M Cement, okay, Malaysian Cement, whereby the Bloomberg consensus TP it's at 6 ringgit 86 cents. Okay, yeah. So for M Cement wise, currently it's trading on an uptrend, and I would be seeing to buy on the breakouts of above 5 ringgit 55 cents. Technically, if we look into M Cement wise, M Cement has been trading on sideways throughout this year. Okay, and in the month of July, we are seeing the breaking out from this range, and it could continue to trade higher from there. If you look into a broader view wise, we can see that the selling down in the month of April, actually it has just touched the 61.8% of the Fibonacci's support level and bouncing off from there. So with the breakouts that just recently happened, okay, we might see this to be the early signal of an upward continuation for M Cement. Okay, and noticing that it is the biggest cement player in Malaysian markets, and also with the rising constructions projects, we might it is likely that we can see M Cement to be benefited from there, and it will be good as a proxy to trade on the construction sector growth. Next, the second one that I'm looking for the third quarter for 2025, it will be Genting. Okay, this will become in line with the increasing foreign tourists, especially we are seeing a large number of tourists from China. Okay, adding to that, we are also personally, I also see that the previous sell down has been overly done, and currently it is forming a MACD bullish divergence. Okay, yeah. So learning from what we were looking having on the Hatta Lega, okay, whereby the bullish divergence it could prolong. Okay, we would want to see the rebound above 3 ringgit 20 cents as a confirmation of a change in trend. Okay, yeah. So for Genting, I would be seeing that the buy opportunity could come at the breakout of 3 ringgit 20 cents, breaking the recent high, and from there it stands a good opportunity to see it retest the resistance at 3 ringgit 40 cents and also potentially cover gap at 3 ringgit 69 cents area. So on the bigger on the larger picture, or on the compressed view of the graph or of the chart, we can see that the selling on Genting has been started somewhere around 5 ringgit and all the way until 3 ringgit to find the support near the 3 ringgit. And recently, with the MACD bullish divergence, the selling has been kind of like halted and starting to forming a higher low. Okay, so as we are seeing the rebound and breakout above 3 ringgit 20 cents, then it could signal to us a potential rebound and also change in trends, turning into an uptrend towards the target that we just mentioned. Our my third pick for this quarter, it will be UE, which is having a bonus issue proposed and in pipeline. Okay, yeah. So UE could be benefited from the rising electricity demands from data center and also tenaga capex. Okay, into the power grids, and also with the strong demand for underground utilities engineering solutions. Okay, UUE has been trading on an upward channel. Okay, yeah, so it's more towards instead of just jumping in, I will see that on the technical side we might want to look for any especially in August and September we might see some weakening in the market sentiments if the seasonally it continue to work in that way. Okay, then we might want to look into some rebound along with the channel for some trading opportunity. Okay, yeah, and as we are buying from there, then it might the potential entry will be somewhere around 80 cents to 84 cents, whereby the potential target that we can see is it might retest the strong resistance at 92 cents or even testing the its all-time high at 96 cents area for UUE. Last but not least, it will be capital A from to be benefited from the tourism parts and also the strengthening ringgit movement. Okay, yeah. So the catalyst for capital A will be positive forex movement and also market is widely expecting that its PN17 status to be lifted by September 2025. Okay, so at this moment for capital A, it is trading on sideways without any strong directions, while the market is waiting for the completion of its aviation sector disposal to its to AX. Okay, and also waiting for the PN17 uplift. So if you are buying into this catalyst wise, you can consider to look for bargain hunting opportunity near 80 cents. Okay, where with the stop loss below 72.5 cents. Okay, yeah, because if it breaks below 72.5 cents, then we might see much further selling towards the 65 cents key support levels. Right, but once the price able to hold well above 90 cents, then we might see a good chance that capital A it might retest back to the 1 ringgit levels or even towards 1 ringgit and 14 cents resistance. Okay, so if we look into a broader pictures, capital A has been trading on a very sideways without strong directions with strong support at 65 cents area. All right. Okay. So that will be the 4 technical picks that I'm putting up for the third quarter of the year. Okay. So if you have any questions, regardless on the economy, equity, market outlook, or any about the stocks coverage that we were sharing this today, please feel free to drop it in the comments and we will attend to it. Okay. Meanwhile, if you liked our section today, please do feel free to share it to on the social media, or you can always scan this QR code to follow us on our social media like Facebook. Yeah, so that we can update with you guys from time to time what with our events. Okay, so we have one questions from Young asking about Gamuda. What is the resistance? Okay, so let me share my charts. Okay, let me share on my charts to look at the Gamuda. Okay. Okay, so if we look into the Gamuda chart, okay, okay. So first, if we look into Gamuda, you can see that Gamuda is currently trading on an uptrend. Okay, on an uptrend, especially after the trend has changed after the breakout from this retracement channel at the break of 4.30 ringgit. Okay, so from there, Gamuda has been trading on an uptrend and hugging well along with the 20 days moving average. Okay, so Gamuda currently is testing its I believe this is all-time high at 5 ringgit 41 cents. Okay, post bonus issue. And with the healthy consolidations along above the 20 days moving average, it stands a good chance to break this high and continue to trade higher from there. So from the price chart wise, there is no other as it is the all-time high, there is no other price resistance from there. Then we can see 5 ringgit 50 cents, and also 6 ringgit as the immediate resistance for Gamuda. Okay, yeah. So as for the support wise, we will be seeing at 4 ringgit 84 cents as the immediate support for Gamuda. Okay, yep. Anyone else have any other questions? Okay, so if there is second rate cut, when would be earliest it will roll out? All right. I believe this second rate cut it refers to the potential OPR rate cut, right? Victor, do you want to share your view on this? If there's second OPR rate cuts, when can we expecting it, and what kind of view that we can look into with this OPR rate cuts?
I don't think there will be another rate cut this year unless
Wait. Wait. Okay, Victor. Yeah, can you share with us?
Yeah. All right. I don't think there's going to be another rate cut on the Malaysian side. If any, I think the earliest would also be in 2026 lah. Right now, I think the rates, as we have mentioned, is very much on a preemptive basis. So it has already been done. Also, if you look at it, the Federal Reserve is likely to keep current interest rates possibly until the end of the third quarter or early fourth quarter. So that means that there's no reason for the Malaysian for Bank Negara to reduce interest rate anytime soon now. So even if there is, it's likely going to be, I think, next year. All right, maybe the earliest, maybe the first quarter, and even that, I don't think is going to be substantial. I think what Bank Negara will want would certainly like to see um, economic conditions stabilize first, and only would implement the second interest rate cut if there is deterioration in the economic outlook. So, in all, I don't expect another interest rate cut this year. Maybe next year. So that's all I can put at this point.
All right. Thank you very much, Victor. Yeah. So David also asking if there's any because I believe with the recent rate cuts, it has bring up some of the trading interest into some property stocks counters. So if we want to look into any property stocks that you like.
Um, You're right. In terms of property stocks, yes, they will be beneficiaries of the interest rate cut. But however, at this point, I think also a lot of it has largely reflected the kind of the interest rate cuts. But to look at just pure players, you'd be looking something like Eco World and what do you call that? And SP Secure, given that they have the what do you call it? The market to actually keep their their sales intact. So, of course, the second line is possibly looking at things like radium and what have you. But I still don't think that certain stocks are in anywhere ready yet. So, if any, I would still prefer the big cap market players like EcoWorld and SP Secure.
All right. So if we look into the Eco World technical outlook, okay, we can see that the Eco World is actually currently testing its all-time high. Okay, yeah. So with the OPR rate cut announced, we are seeing the increasing volume in Eco World, and also it has been testing the high at 2 ringgit 17 cents over here. Okay, so if for breakout traders, you might want to continue to see Eco to trade somewhere around above 2 ringgit to 2 ringgit 17 cents to 2 ringgit 15 cents, and following that we will be looking for the breakouts above 2 ringgit 15 cents for a momentum trades on Eco. Okay, for SP Setia wise, if we look at SP Setia is more towards trading on sideways trends. Okay, with the 20 days moving average pretty flat, and it has been well resisted below 200 moving average. Okay, so for SP Setia, if you're bargain hunters, you might want to look somewhere around 1 ringgit to pick up some of the chip at a cheaper price. Okay, otherwise we might really want to look for the rebounds and break out above 1 ringgit 25 cents in order to trade for a potential upward trend towards 1 ringgit 40 cents to 1 ringgit 50 cents resistance area. Okay, otherwise, if we look into technical view wise, it could impose a better trading opportunities and also a better market momentum for us for a short-term trading. Okay, for the property stocks. All right. Okay, so if there's no other questions, then we will end our section here today. Okay, so thank you very much for joining our section today, and thank you and have a good night. Bye bye.